Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining us. We have a fantastic week ahead, really. The start of the week on Monday was very quiet, but that's not entirely unusual. The rest of the week, though, really does just ramp up quite considerably. We've already started that today now, as you can probably see on the screen in front of you. Boris Johnson has won the UK leadership race, beating Jeremy Hunt quite considerably. I think he received around twice as many votes as Jeremy Hunt did. It's not an altogether surprising result. I think he's led very comfortably throughout all of the initial stages of the race itself. Got down to the final two with Hunt being a initial Remainer, which will have deterred a number of Tory membership voters straight away. Says he's a converted leaver, but very much not adopting the same hardline approach that Boris Johnson has, especially with relation to no deal. So we have a new leader. We will go through the market reaction to that when we move on to the charts shortly. But this is now the first major event of the week out the way, and there's so much more to come. We'll nip onto the economic calendar to take a look at a number of those now. For those of you who aren't aware, this is the OANDA MarketPulse website. This is where myself and my colleagues post our articles every day. We post them from around the world, so you get 24-hour coverage, depending on where you are. You'll always have something that you can take a look at. We cover a wide variety of instruments as well, so hopefully there's something there for everyone. It's also where you'll find the recording of this webinar later on today, as well as the economic calendar, which we're going to take a look at now. Now, as always, I've narrowed this down by the relevant instruments for the charts we are looking at. If anyone wants to take a look at anything else or has any comments or wants to ask any questions, then please do feel free. As ever, this is meant to be an interactive session. The calendar you can see in front of us, you can see that it's very heavy towards the middle and back end of the week. As I said, yesterday was very quiet. There's a couple of reasons for that. One is the simple fact that we have no Fed speakers this week. So that's one of the type of things that we can typically see maybe early in the week, maybe spread throughout. But with the Fed interest rate decision next Wednesday, we are now in the blackout period that started on Friday. We had a lot of Fed speak over the last couple of weeks. It left people with a bit of a confused picture in many senses. Markets kept changing their minds on what they're expecting. Didn't expect a rate cut at the meeting next week. But the probability of a 50 basis point cut is the thing that did change on a regular basis. Now, I think it was quite clear by the end of the week what the Fed is going to do next week, and we'll cover this in more detail during the special FOMC webinar with myself and Ed next week. But I think it was quite clear after Thursday and Friday. On Thursday, we heard from Fed Bank of New York, John Williams, the president there, and he said in a speech basically that the Fed needs to be considering effective preemptive rate cuts at this stage because their artillery is lower than it's been before. Then what's going to be far more efficient, rather than waiting for a crisis to happen, is to be trying to nip it in the bud early before we start to see a crisis unfold. That again alluding to the belief that we are going to see rate cuts this year, even though the economy doesn't seem too bad. Now, following that, the market starts to heavily price in a 50 basis point cut at around 40%, so very considerable, to the point that the actual the New York Fed actually released a statement shortly after, which is very unusual, trying to clarify his comments, saying that this is not indicative of future policy, particularly not the upcoming meeting, that this was just a lecture, that it wasn't a reference to any upcoming decisions. So clearly not liking what it had seen from the market. So that was a clear signal there that it doesn't want the market to price in 50 basis points. This was followed on Friday by James Bullard, who is arguably the most dovish member of the Fed, but I would certainly say the most dovish voting policy member this year. And he said that he effectively favors a 25 basis point cut still, as he said a few weeks ago, and he thinks 50 basis points would be too much. At this point, I wonder why a 50 basis point is priced in at all. I don't think the data can deteriorate to such an extent to change their views in such a small amount of time at this point, or it will. I don't think it will anyway. And therefore, I think the fact that we did drop to 20% yesterday and now 15% today, I'm surprised it's even that high. which maybe means that there's potential for the dollar to make a bit of a comeback over the next week or so. But it's hard to say because clearly markets want more. And even with these warnings from the Fed, they're still continuing to push for it. Maybe any weakness in the data will convince them to continue to push, but then that really does leave us set for disappointment in a week's time. So like I say, no Fed speak this week because of that blackout period, but there is plenty more to focus on. Today, we've had the leadership results. I've just touched on it. Boris Johnson winning with a significant majority. We'll come back to that when we look at the chart. We've got loads of manufacturing and services PMIs over the next couple of days as well, from Europe, from the UK, from the US. So plenty to be keeping an eye on in terms of data throughout the early parts of the European session and the hour leading up to the US session as well. New home sales, of course, on top of that. One housing data obviously has been one pocket of weakness in the US economy. Existing home sales actually is released later on today. Now, this takes us through to Thursday, and it's this part of the week where we really start to see things ramp up, because not only do we have plenty of data, and I'm looking at the IFO German figure, the jobless claims, durable goods orders, we also have an interest rate decision from the ECB. Now, we're not expecting an interest rate cut this month, but many economists are actually factoring in one for September. I personally think that's a mistake. I don't think that the data has deteriorated to such an extent that we really need to see a December rate cut. I think their artillery is much lower than everywhere else because they are in negative interest rate already. And also, we're going to have a new ECB president in October. It seems bizarre to alter the course of monetary policy and start cutting rates again 1 month before. I feel like that's the type of decision that can wait for the new ECB president, which is likely to be Christine Lagarde. For those of you who have been in this game a while, you'll remember that back in 2011, Jean-Claude Trichet actually, the Jean-Claude Trichet-led ECB actually raised interest rates in the meeting before Draghi took over. And that's something that the Draghi-led ECB then had to reverse very quickly after his appointment and then go further again. I wonder why the ECB would want to engage in something like this again rather than just hold off. It seems a strange decision. They do like to make these decisions during a meeting when they have new economic projections, which I think is why people are taking a nod to September. But in that case, I'd be surprised. I don't understand the rationale for not holding off until December. And if anything, we have seen a bit of a bounce in the European data recently, which again really supports the wait and see approach. Now, I know this is an FX webinar, so I'm not going to delve too deeply into it, but this week is also earnings season, and that really starts to ramp up on Wednesday and Thursday. Some major companies actually reporting earnings as well. We've got 4 Dow companies today, but we've also later on in the week, we've got Amazon, we have Apple, we have Alphabet, we have Facebook, Twitter. All of these massive names, all are releasing earnings later this week. It's around a third of the S&P 500, all releasing earnings this week. You can't convince me for a second that that's not going to have an impact on sentiment in the markets, which does reverberate across markets, whether you're equities, indices, single stock equities, indices, commodities, spread, FX, whatever. The sentiment impact is going. It certainly has the potential to filter through. So I really think this is something worth focusing on over the course of this week, seeing how this is doing and seeing what impact it is having on traders, seeing what impact it's having on people's interest rate expectations. Of course, a very poor earnings season may further convince traders that further interest rate cuts are necessary. And then this takes us to Friday. So Friday, I think it's going to be a bit quieter on the earnings front, but we do have US GDP. Now, the US surprised in the first quarter, releasing data showing it grew by 3.1%. Now, we were expecting around 2.5%, or the market was expecting 2.5%. So this was well above expectations. And what it turned out this was down to was inventory building and a decline in imports. Now, this tends to be a temporary factor, but it also tends to be a factor that will hit following numbers, because you can only build inventories for so long. At some point, you have to sell those inventories, and if there isn't enough demand for them, then you have to stop producing these inventories. So this is expected to weigh on the actual number for Q2. Now, the timing of this isn't ideal, because when people are factoring in a slowdown, calling for more interest rate cuts, This earnings season is expected to confirm that we're in an earnings recession, which means we get 2 consecutive quarters of negative earnings growth. When you're also showing that you're growing at only 1.8%, that is only going to spur further calls for interest rate cuts. So it'll be really interesting to see what the reaction to this is going to be on Friday, especially following a slew of massive earnings on Wednesday and also on Thursday. We'll also get consumption expenditure prices as well, another notable spending metric. But that GDP figure is massive. I really do think it could really shake things up in the markets, unless it, of course, comes in within line with expectations. But even then, I still think there is potential for this to have an impact. So loads and loads and loads to be watching out for this week. I'm sure I've probably missed a few things off, and if I have, then please do let me know, and we can always discuss them. But these are obviously the major economic events that we are facing over the course of the next 3 or 4 days, which is going to make it a really fascinating week, I think. Now, if we go on to the charts, I'm going to do them in a normal order. So we will touch on the sterling part as we start to move through, for those of you who are interested in the leadership race. But we'll start with euro dollar. Now, euro dollar has been making its way lower again. We did start to see a bounce on the back of people factoring in more interest rate cuts from the Federal Reserve. That's shifting in communication from certain policymakers, particularly Jay Powell, the chair, who during his congressional hearings in the front of the Senate Banking Committee and the House Financial Services Committee, was repeatedly alluding to the soft patches in the US economy, to the softer levels of inflation, which they didn't think was going to go away too quickly, playing down the strong aspects of the economy, most notably the jobs report, so the unemployment data, the job creation figures, the earnings figures, playing these down, talking about the fact that they look at a whole host of data points and it's not all good. All of these things led to people factoring in more rate cuts from the Fed, suggesting they'd finally caught up with market expectations. Now that we've started to see a reverse within this, now that we've started to see the Fed downplaying the scope of the cuts, now we have started to see this turn a bit lower. We're coming back towards these kind of 112 levels. We're dipping just below here. I've still left the 78.6 fib on there simply because this is still rebounding from a long-term low, so sharper corrections I don't think are particularly unusual. If we break through that 111.70, then that would suggest that we're potentially aiming for those lows again, that we're potentially going to see a test of those 111s. I'm not overly convinced that we're necessarily going to see that broken at this point. And the reason isn't because I'm in line with the market view that we're going to see a lot of rate cuts. I'm not. But I think that the market is convinced. And when the market's convinced, you can typically see strong reactions to certain pieces of data more so than others. Like I say, we're in the midst of an earnings season when people are expecting an earnings recession. We are going to get a GDP number on Friday, which could potentially be quite weak. And there is therefore scope for people to jump on. They've also got a couple of other pieces of data, of course, the housing data, manufacturing PMI, etc. this week also. And I think pockets of weakness could potentially be jumped on. And that could, again, soften the US dollar. Maybe it won't drastically increase the probability of a 50 basis point cut this month, but it could encourage greater cuts to be priced in over the next few months heading in towards the end of the year. The markets still seem convinced we're going to see 75 basis points in cuts this year. I am not. I think 50 basis points at most, and I think even that's a bit unnecessary, but we'll see how things go. The Fed's clearly been bullied into cutting by 25 basis points in the July meeting. You can see there's still a reluctance, but they are changing the communication to allow for it. And when I say bullied, I'm not one of these who thinks they've been bullied into it by Donald Trump and the administration. I think they've shown quite clearly that they're not willing to be bullied by the administration and convinced and pressured into doing as they are told. In fact, I actually think that's led to policy mistakes, as I've alluded to in previous webinars. I think that the December rate hike was an act of was the Fed effectively acting out against the administration, and I think that was a wrong decision. I think had the Trump administration, led by the president himself, obviously, never said anything in relation to monetary policy, I don't think the Fed would have actually cut at that meeting. And I think it's potentially led to further policy mistakes so far this year, in that if they were going to reverse it, I think they could have reversed it earlier and have instead hold off against the market wishes because they don't be seen to be influenced again. So I do think that the Fed is going to be reluctant to cut 3 times this year, or cut by 75 basis points. I really do, and I think the markets are too heavily pricing that in. But again, we'll see how that goes. If the market continues to bully, then maybe the Fed will continue to oblige. So we're trading below those 112s. If we break below this kind of 111.70, then the lows will be very interesting, especially if we fail to make a new low before rotating high. Because again, what we want to see if we're seeing these lows attacked is momentum building, not waning. Which takes us on to the British pound against the US dollar on this occasion. Now, for those of you who checked out that piece, the Boris PM piece, I highlighted the 1 minute chart. I rarely look at the 1 minute chart, if I'm honest. But what I wanted to really highlight here was that the markets didn't react negatively to it. Now, when you look at the daily chart, you can see that actually since the 13th of March, markets have been heading south. And that was when it became apparent that Theresa May was done for, when it was quite clear that no matter what happened, Parliament was not going to vote for her deal, that there was going to be a leadership race. And then it became increasingly clear that Boris Johnson was the strong favourite during that leadership race. And over the weeks, it's just been more and more priced in that we are heading for Boris Johnson becoming the new UK Prime Minister on the 24th of July. And his rhetoric hasn't softened during that time, very much playing to the Tory party membership, talking about how it's essential that the UK leaves the EU on the 31st of October with or without a deal. That doesn't leave him much time, talking about how the current withdrawal agreement is dead, or the backstop's dead, which in effect would suggest that the current withdrawal agreement is, of course, dead. Now, a lot of this is going to be playing party politics in many ways. I think there is a belief that we could see a version of the withdrawal agreement that comes back before Parliament, maybe with a few tweaks in terms of the future declaration. Again, there's been plenty of phrases banded around, putting lipstick on the pig, I think, or something like that gets brought back. Given the how do I say, given the comparable nature that people associate Boris Johnson with Donald Trump, I think there'll possibly also be a rebranding exercise in which the withdrawal agreement will be touched up and given a whole new name. Again, this is a strong Brexit here, so I wouldn't be surprised to see something called, say, the Independence Bill appear before Parliament, which is 99% the same as the withdrawal agreement, but something that the Brexiteers can get behind and claim to be vastly different, though most people will not look at the finer details of it. And then Boris will be the man who delivered Brexit. And again, I think Brexiteers will find it a lot easier to line up behind someone like Boris Johnson than they ever would behind Theresa May, who is seen as a conciliatory Remainer who couldn't accept the result and was never a true believer in the actual cause. Obviously, that is a big mouthful, but what it means from a market's perspective is that the risk of no deal is more than it's been at any point under Theresa May, because Boris Johnson has repeatedly said that he will leave without a deal if the only deal on the table is what it is currently in front of him, if it includes the backstop. Now, Parliament isn't behind that, which is why we've all of a sudden be talking a lot more about proroguing Parliament. This effectively means putting Parliament into recess for 2 weeks around the 31st of October deadline so that Parliament cannot stop it. Now, this has been heavily debated. There's been efforts in Parliament to stop it, the latest of which was successful. But again, don't be surprised if Team Boris is continuing to look for ways to get around Parliament and stop them blocking no deal. That's not, again, to say that he wants to actually deliver on no deal Brexit, but he wants the threat to be real, because where Theresa May failed in Brussels, where she was saying in public, in the media, no deal is better than a bad deal, but then she was also saying in public that no deal will be disastrous for the UK economy and they want to avoid it at all costs. That is as empty a threat as you can possibly say. That is going all in poker while turning over your cards and showing that you've only got a 2 and a 7 offsuit. For those of poker fans of you will know that is the worst hand in poker. And bluffing is a major part of the game. But obviously, if other people can see your hands, then your bluff is completely worthless. And that is effectively what Theresa May has been doing for some time, and why the EU never really bought the threat that no deal is on the table. But people will buy it more so from Boris, because he has stood by it so strongly. Now, that may beg the question then, why is the pound not continued to sell off once it was confirmed that he was the winner? You can see here that this is where we were trading when the announcement was made, and we're now trading 3 or 4 pips below that. The simple reason for that is that it's been so heavily priced in that there wasn't much left to do. So instead, we actually saw a little bit of profit taking, it seems. There's potential, I think, maybe even for more profit taking in the near term, because it's been priced in over such a long period. I do wonder whether there is scope for more profit taking before we see another attack on the lows. The end of the day, we're going to see what his cabinet's going to look like over the next few days, but we're now heading into summer recess period. You have to wonder just how much can actually be achieved over that month-long period. So obviously, from a market perspective, a much quieter period as well. I think the real action is going to start to come into play in September and October time. Again, I'm sure we'll learn a lot more about that over the coming days. But given how much sterling sold off, and given the momentum which is which has been lacking out of those recent moves, I do wonder whether this is potentially a market prime for a correction. But again, I think this will be much clearer over the next couple of days. Really, the initial response around the actual announcement was barely visible, and I do think that is just because it was an event that was entirely priced in. The question now is, do we see a corrective move because of profit taking, or are the people who've been selling during this decline, are they so convinced that no deal remains such a big risk that they think actually we can still hit 120 over the next 3, 4, 5, 6 whatever weeks, because that doesn't change, and therefore this conviction in the fact that we are heading lower, and because the time frame is so small, that they continue to push that market lower. If we are going to see that, then I would like to see momentum pick up, and that's something that really is lacking though at this moment in time. Euro sterling, same applies. We've seen a very strong deterioration in the pound over the course of the last couple of months, which has benefited the euro in this sense. But again, we are trading at peak territory. Now, we've highlighted it from here to here, and I know it's a wide range, 89.50 through 91. I've explained this in these webinars before, but I'm not really interested in narrowing the range dramatically. I'm looking for ranges where we could face difficulty. And this goes back well beyond here. This actually goes back through to September 2017. Every time we approach these levels, we run into a bit of a ceiling. And now we are starting to run into a bit of a ceiling again. Again, look at momentum. The stochastic, the MACD moving averages all pointing lower despite making new highs. The histogram the same, and look at that on the stochastic, very much the same. This suggests to me that this is a market which will really struggle to break through 91. If we do break through 91, then I would expect these momentum indicators to change to match that, if it is actually built on substance rather than quicksand. And looking at this, and I'm not confident we are even going to touch those 91s, let alone break through them, because of what we are seeing on those indicators below. I do still think there's an element of profit taking kicking in, but again, let's see how this goes over the next couple of days. The ECB policy meeting, of course, on Thursday is going to have a major role to play within that. And if we get the dovish message that many are expecting ahead of that September meeting, that could aid the move lower in that pair. Aussie dollar, we were seeing a bit of a backtrack in the US dollar. I haven't removed this this Fibonacci yet. We did rotate off that 61.8 fib. Of course, Ed carried out the webinar last week, which is why I haven't updated on this move. We came back to the 61.8 fib. Again, like euro dollar, we'd been rotating lower for such a long time. There was scope for this to come out back to the 78.6. Instead, we've rotated nicely off the 61.8, and then we've made a new high. That's not over though, let's face it. Just because we made the new high, it doesn't mean that the downside, the decline is over. I think we need to see a break of the 71 for this to have any kind of conviction. At the moment, it's not looking too bad. I wish we'd seen a bit more momentum on that most recent high, but it's natural to run into resistance around into difficulty around such a key area of resistance. If we can break through that 71, then I think this has the potential to really gain some legs. At this moment in time, we remain below, and we have been disappointed on a number of occasions when we've been testing this 200 to 33-day simple moving average band. Most notably, I'm looking this year at January and April time. It seems to be a periodic every 3 months thing, actually. if we can break through then I think that could make this chart really, really interesting. This chart got interesting a while back, and it's just continued to be so. We've seen an aggressive sell-off here, driven primarily by the Canadian dollar in terms of strength on the back of the rising oil prices, on the fact that it's one of the few central banks which people do not expect to actually be cutting interest rates, and of course, on the market increasingly pricing in rate cuts in the US. Now, we came back towards this kind of 130.50, 130.70 level. We did find some support. We have dipped below it, but if we look at the momentum indicators again, that would show that we've run into some substantial support. We're testing the 130-150s here, and it looks like we've got a decent bit of momentum into it. If we can break through that, then that could suggest that we are seeing a bit more of a correction. And again, when you look at these kind of double bottom type moves, and this is very imperfect, this could be a double bottom, it could be a triple bottom, it could be neither. But if we're looking roughly at the size of the move here, you're around 130.40 through 131.40, 131.50. So that suggests we could see roughly 100 pip move to the upside if we do see a breakthrough these 130, 150 highs, where we have run into resistance on a couple of occasions. Again, it's imperfect. I'm going from the textbooks. Nothing's guaranteed, but it could potentially be an indication of a decent move higher, potentially back towards these kind of 132.50s, which again is a very interesting level around these 132.50s, 133s. You've got the culmination of the moving averages and the prior area of support. I imagine if we throw a fib on there as well, it could actually throw something up on this also. So that 132.50s, 133s also coincides with a 38.2 to 50 fib kind of range. So that if we can break through here, then that range starts to become very interesting in the dollar CAD pair. Obviously, when you throw up a strong currency against a weak currency, you get something that looks almost like a straight line, or very much in this case. We've been taking out support levels for fun here with very little test along the way, to the point that we've come back towards these kind of 162 areas. 162, you can see back in this period here, was a notable level of support, and here as well, and then resistance when we tested it from below here. So this is where we have run into some support. Now the question is, are we just seeing a little bit of a blip? Is this kind of a dead cat bounce, or are we going to see this gather any kind of momentum? Well, what was interesting was when we saw this decline, this was actually quite a sharp decline from the 163.50s through 162, but we didn't even see a new lower low on the stochastic, and look how much that shot higher off such a small move. That would suggest there's not much belief in the downside because the intensity with which we've seen this decline. Kind of confirmed as well by the MACD histogram flattening in the MACD. If we can see a breakthrough these kind of 164s, then potentially the scope for some more upside. Plenty of resistance to be seen around these 166, 160, initially potentially 167.50s. And again, I think the momentum indicator is going to be key here, because let's face it, Fibonacci levels are pointless at these kind of levels, because we're looking up here for the 50 fib, and at this moment in time, it just doesn't look like it'll have the legs. Kiwi dollar versus the US dollar. Now, it looks like there's a lot of noise on this at the minute. Let me explain things before I start to remove them, because we have been looking at tracking this for quite some time. We had this orange fib on here as well. This was on here to begin with. This was the most recent highs to the most recent lows, long-term highs, long-term lows, 2018 highs and lows. We came back, we tested the fib on a number of occasions, and we failed to break above this. So this was potentially a bearish signal lining up. What's cast a lot of doubt on that is the fact that we failed to make new lows on 2 occasions before making what looks kind of like a double bottom here around the kind of 166.80s, where the neckline is, to the kind of 164.80s, which is where the bottom is. So that's around a 200 pip kind of double bottom, and then we broke above. Now, when we broke back above there, then that suggested that this move was effectively null and void, and wasn't not necessarily null and void per se, because we still haven't broken through the 169.50s, but it would suggest it had lost its significance, should we say. So I in that sense, it's worth removing off the chart. Now, when we see, then we came pull back immediately after breaking through those double top neckline. We didn't get very far, which is always a little bit of a worrying sign. But in those situations, I think it's always worth checking the fibs from the low to the high. This low from the second leg on the double bottom to the high on the most recent breakout. Now I know we've got a lot of fib levels on here, but if you can just try and stay with me on this orange fib here. What you'd like to see typically is to see this prior resistance area here act as support and the market rotate higher off there. It looked as though that was potentially what we were seeing, but we failed to make a new lie, and then we really properly dipped lower. So this is where the fib comes into play. We came into this 50.61.8 fib zone, and then we've rotated higher off here. We've broken through new highs and continued that ascent. So that gives us confidence in this near-term rally. If we've got a 200 pip double bottom here, then per the textbook, this gives us a possible price projection of around 168.80. We are yet to hit that, so that would suggest that potentially we do still have a little bit further to run in terms of this ascent. And especially when 168.80 does coincide with these highs, then that starts to look very, very interesting. So as I've said, if we can break through here, then that would suggest momentum is regained with the bulls, which, considering the movements we've seen in the US dollar recently, does make a lot of sense. Now, we've found support initially around these kind of levels here, really around the 167 through that 167.25. If we can stay above these levels and potentially rotate, then that would be a nice little bullish signal, at which point that 167.90, 168 starts to become the interesting level above here before looking at these kind of upper ends of the zones. Like I say, there's still a long way to go on this, and I think it's still very it's very much a mixed picture because of the choppiness, because of the back and forth, which there's the lack of a clear trend, I guess is what I'm trying to say. The fact that we've gone through this 68-point fib means I'm not interested in this fib level anymore. If we were going to rotate off the 50 to 61.8 area, then that would bring a lot more interest back to these lows and suggest that maybe this was just a little bit of a blip here that we've seen more recently. This suggests to me that the downtrend is weak, confirming what I've already said when removing the initial long-term fib level. Now, I know I've said fib a lot. I know I've used a lot of fibs in that, but hopefully that makes sense. If it didn't, then please do go back and take a look at this last couple of minutes again. If it still doesn't make sense and I've just not explained it very well, and you do want to know more, please do just reach out to me on Twitter, Craig_Forex, and I'll happily have a chat about that again. The point being, if we can stay around this above this 167 and even above this 167.25, then we could be looking back towards these kind of previous peaks again, and all of a sudden that's 169.50 through 170 through 69.50 through 70 starts to look very, very interesting once again. As ever, we'll wrap things up with these yen pairs. Now, again, this is the yen pairs. I've said this quite a few times in these webinars now. The yen pairs just aren't really of interest to me at this moment in time. I really do struggle to get some enthusiasm for them. It's primarily being driven by the dollar. Risk appetite isn't really playing that much of a factor right now. We rotated back to these lows here around 107s, which you can see. I've said before, dollar yen, for example, 108, 107, 106, 105. These are all notable areas of support and resistance, big round numbers, but it's big round numbers that the market does pay attention to. So we broke 108, we hit 107, we've rotated higher. We had a bit of a corrective move. We rotated back off 109 and came low. We came back into this descending kind of channel movement. We've kind of stayed in here, but it's a bit messy. So I'm going to remove it because now it just starts to get a bit messy, and it's where I start to kind of lose interest in it. I'm still interested in these 108s, even though we've chopped through here a couple of times more recently. I'm more interested in 107 and 109 though. A break above 109 puts the interest back on 110, and 110 is interesting, not just because of a big round number and because it's been an area of support and resistance before, but also because it marks the top of the Ichimoku cloud. A breakthrough there brings us back into bullish territory. I'm not convinced it has the legs yet, but let's see how we trade when we get to that level. A breakthrough 107 suggests that we are still in bearish territory here, that the weakness in the dollar is overpowering the fact that we're not seeing too much risk aversion generally right now, which could potentially drive the yen higher and this pair lower. And that then puts the spotlight on 106. And again, the same applies as what I was saying earlier on. Sterling yen, again, this pound has just performed terribly, but the trend is weakening. So we're approaching this support level here around 132.50, 133.50, so we say roughly. these levels sometimes give us something specific, but I'm kind of interested in the area more so than anything else. As we approach this level, the trend is really weakening. We haven't really seen any signs that we're bursting high yet, so I wouldn't be surprised if these do get tested. But really, this is a trend that's been one direction for some time, but it is weakening, and we're not seeing any real indication of that picking up. Of course, if the momentum indicators change, then so does the view, but at this moment, neither of those things are looking true. And finally, we wrap things up with the euro-yen pair. We are testing the lows again. We rotated off that kind of 38.2 fib on a couple of occasions. I thought that was interesting because that's just a weak rebound. And now we're testing the lows. Now, it is possible that we've just kind of entered into this new trading range, really between 123.50, 120.50. We're really struggling to make a breakout in really any other direction. I'd like to see a break lower, if I'm honest, because that could potentially spur this trend on further. But you look at what we've seen over the last 4 days, it doesn't offer me too much hope. The only thing that does provide me some hope is that we're not rebounding either. Even we're struggling to break, but we're failing to rebound. And momentum kind of seems to be building despite the fact that we're failing to make new lows. If we can push below there, then maybe some spot stops will be triggered, and that can spur some life back into this once again. If we do rotate higher, then of course 122, 123.50 area then starts to look a lot more interesting to the upside. But again, this is a yen pair, and it's just not something that is of huge interest to me right now. Okay, that's all for today. I hope you found that useful. I hope you enjoyed it. For more analysis, do check out MarketPulse. That's marketpulse.com. It's also where you'll find the recording of this webinar a little bit later on. You'll also find it tweeted out on Twitter, Craig_Forex. You'll find it on other social media channels as well. Please do check out future webinars as well. Go to the education page, sign up there, and you can also check out the other stuff which we're putting out as well, things like the podcasts, etc., OANDA Market Insights. It'd be great if you could check them out, give us your feedback, and let us know what you think. But in the meantime, I wish you all the best of luck with your trading. It's going to be a fantastic week, really interesting week. So I wish you all the very best of luck with it, and hopefully you'll join us for the special FOMC webinar this time next week. And until then, thank you very much and all the best.